All right, welcome. Today, we're going to break down one of the most powerful and, let's be honest, most misunderstood tools in finance, options trading. Let's get your foundation built starting right now.
Okay, let's dive right in with a question that really gets to the heart of why options even exist. So imagine you are absolutely sure a stock is about to take off, but you don't want to tie up thousands of dollars buying the shares. What if there was another way to play it? Well, that's exactly what we're here to talk about.
So what is an option, really? At the end of the day, it's just a contract. And every single options contract is built on two key ingredients. If you can get these two things, you've got the basics down cold.
First up, every single option has an expiration date. Now, this is totally different from a stock, which you can hold on to forever if you want. An option is temporary. It has a ticking clock. This is so important because it means time is always a factor in your trade. And the second ingredient, that's the strike price. Think of this as the locked-in, pre-agreed price. Whether you're planning to buy or sell the stock, this is the price that is set in stone for the entire life of your contract.
So here's the crucial difference. Owning a stock is like owning a piece of the company itself, with no time limit. An option, on the other hand, is a temporary contract that just gives you the right to do something, like buy or sell the stock without actually owning it. It's all about rights, not ownership, and it's always on a timer.
You know what? To make this crystal clear, let's just forget about stocks for a second. This super simple real-world analogy is going to show you exactly how the most common type of option works.
So let's talk about a house. Let's say you are convinced its value is about to skyrocket, but you either don't have or just don't want to commit the full $200,000 right now. So instead of buying the house, you buy a contract, an option on the house. Here's how the best-case scenario could play out. You pay a small $10,000 fee. Think of this as the premium for the contract. What that gets you is the right to buy that house for $200,000 anytime within the next year. A year goes by and bam, you were totally right. The house is now worth $350,000. Your little contract is suddenly like a golden ticket, right? It gives you the right to buy a $350,000 asset for only $200,000. After you subtract that initial fee you paid, you've just made a net profit of $140,000.
But, and this is just as important, what if you were wrong? What if the house price dropped to $150,000? Well, you wouldn't use your contract to buy it for $200,000. That'd be crazy. The contract just expires. It becomes worthless. And here's the key. Your risk was strictly limited. You only lost the $10,000 fee you paid. You didn't lose the $50,000 you would have lost if you'd actually bought the house outright. Huge difference.
Okay, so let's take that exact same logic and bring it back to the stock market. Because this is where those concepts of controlled risk and amplified returns, what traders call leverage, really come to life.
That whole house analogy? That perfectly describes what we call a call option. It's a contract that gives you the right, but not the obligation, that's a key phrase, to buy 100 shares of a stock at that locked-in strike price. To put it simply, it's a bet that the stock's price is going to go up.
And this right here, this is the main attraction of options, leverage. Look at this example with Tesla. A tiny 3% rise in the stock price led to a massive 15% gain in the call options value. That's 5 times the return. This is how you can get in on the action of expensive stocks without having to fork over all the money it would cost to actually buy the shares.
However, and I cannot stress this enough, you have to understand the risk. Just like our house analogy, if you're wrong about the stock's direction, or maybe it just doesn't move before your expiration date, that option contract can expire completely worthless. Your maximum loss is capped at what you paid for it, but that can absolutely mean losing 100% of your investment.
So we've covered betting on a stock's rise with call options. But what if you think a stock is overvalued and is headed for a drop? Can you profit from that? You absolutely can.
And that's where put options come in. They're the mirror image of calls. A put option gives you the right to sell 100 shares of a stock at a specific strike price. It's like having a contract that lets you force someone to buy your house for $200,000, even if its market value has crashed to $150,000. It's designed to profit from a decline. And this just shows you the beautiful symmetry between the two. A call option gives you the right to buy when you think the price will go up. A put option gives you the right to sell when you think the price will go down. If you understand one, you really get the other. You just flip the objective.
Okay, we have covered a lot of ground pretty quickly here, so let's boil it all down to the absolute essentials you should take away from this.
Just remember these 3 things. 1. Leverage. Options can seriously amplify your gains, but they can do the same for your losses. 2. Limited risk. When you buy an option, the most you can ever lose is the premium you paid for it, period. And 3, direction and time. And this is the tricky part. You have to be right about which way the stop is going, and it has to happen before your contract expires.
And there you have it, a solid foundation for how options work. They are incredibly powerful tools, but they are not lottery tickets. You have to treat them with respect. Now that you've got a solid foundation, the real learning journey can begin. Thanks for tuning in.